out some of the key themes in the markets and looking at how that's been retrospectively displayed within the price action over the last week or so. So before we get into it, some big updates coming from ourselves for the beginning of July. So make sure you keep aware or keep an eye on our social media pages for updates regarding the business from ACG over the weekend and of course from the beginning of July. So for those of you who are following our active social media pages and are active in our Discord, you will be made aware of some really important business updates coming into place from the beginning of July. So moving across into, I suppose, the dynamics this week, we've had another very, very choppy week in the markets, broadly speaking. We've had a lot of high volatile data events, really Wednesday, Thursday, and obviously this afternoon. With central bank speakers, central bank panel meetings. We have had a wide number of really important data points, for example, GDP, harmonized consumer prices, business confidence and consumer confidence, as well as unemployment rate and another really important data. So it really kind of started Wednesday, right? The pickup in volatility was really kind of began in earnest from Wednesday after the or into, should I say, the ECB panel meeting, which had FED Chair Powell. We had the BOJ Governor Ueda, Governor of the Central Bank of England, Governor Andrew Baily, and of course the ECB President, Madame Lagarde. So of course Wednesday we had that kind of synchronization and increased volatility. And we did see obviously indices holding up relatively well kind of Tuesday and Wednesday. We talked about that in our daily notes earlier in the week, midweek. And we've seen today into month end, into quarter end and into half year end, we have seen some very important and significant price action in the markets. We're seeing the stock markets continue to churn higher. We're seeing regressional trend movements, particularly in gold, playing out very, very nicely off of key levels, key liquidity areas, factoring that back into actual physical price action. And of course, we're seeing that continued chop and volatility in the FX markets, in the primary dollar pairs, the majors, and of course into secondary assets like the euro, the pound, the yen, which also over the last number of weeks has seen fairly significant volatility. We've seen that yen weakness become a secondary story across the board in the last couple of weeks, particularly against the likes of the euro, the pound in particular, but even so against the dollar, which we'll be looking at today. And of course, looking at other macro fundamentals, like, for example, this, shall we say, fairly resilient growth figures, particularly for the likes in the US, and of course, the inflation figures and higher rates that's been witnessed both in Europe and, of course, in the UK by the Bank of England and ECB, respectively. So that's really kind of where we are this week. We're seeing indices do relatively well into half-yearly cycle end, into the 30th of June month end today. Despite, as I said, US, should I say, growth data yesterday was fairly strong, fairly resilient. 2% annualized Q1 figures shows that it was coming in modestly above expectation. So despite the idea of potential rate hikes in different markets, overall indices are doing quite well. We're seeing European indices bounce back today following the US. We're seeing US indices prove to be very resilient. And I suppose that's really going to be the tone this week to see into month end, half year end, and of course quarterly end as well. Particularly with big redemption dates by funds, will we see the indices actually close to new cycle highs or close at cycle highs? And I suspect that's going to be very much the case into 1st of July and of course into early July as we start a new quarter and a new second half of the year next week. Now, moving across to the price action, right? So to visualize that in retrospect to the price action, we've seen some fairly significant movements in the markets this week compared to where we were on Monday. We talked about it last week. This 43.45, 43.65 level was quoted last week to keep an eye out on to see if there's any sort of market reaction. We saw an initial burst on Tuesday. We saw a little bit of a steady move Wednesday into obviously that panel meeting by the ECB, but of course Wednesday, Thursday, and aggressively today we are seeing US indices rally higher with very, very clear buying opportunities. And you'll see even now at 44.50, we've taken out previous highs that was visualized in the middle of the month of June. Now you go back up to put some perspective on things. Look at where we've come really since mid-March, right? This is our March lows down here. This was prior to the most recent Fed meeting or last couple of Fed meetings. We have seen US indices continue to chug higher to the upside, creating new cycle highs from where we were last October, last November. So it shows that broader market dynamic is moving higher. There is an expectation of Fed weakening coming in by investor sentiment, and that has been very much regurgitated back into positive stock market gains again for another positive week, and it looks to be another positive month. And if you dial out to the monthly chart as well to put a wider time frame viewpoint on that, you'll see that very, very clearly. Right, so we started to see the buying coming through really in earnest in March. We followed up with a strong month in April. May was quite consolidated, and we've really rounded out the quarter and first half of the year with very, very aggressive moves in June. And we are very much pulling back into this previous cycle set of highs that was formed here in 2021, early 2022. So that's putting a larger time frame perspective on it, right? So we're seeing the same moves really across the board. We're seeing NASDAQ continue to churn higher. That very, very aggressive break to the downside last week has become all but undone. Really from where we were on Tuesday, that aggressive move on Tuesday, we've continued to grind higher Wednesday and Thursday, and of course today we've taken out short-term order flow to the downside, and we have pushed back into session highs, back into this 15 to 50 area, and that's really been the catalyst this week, this kind of continuous break to the upside, which is really kind of drove home that idea of stronger indices for the first half of 2023. Now, similar to that, obviously with Dow Jones, we're back really to where we were. We did have that pullback zone into this 33.7, 33.800 level. Again, another area of interest that we kind of talked about. Very, very strong rally back up. And now within a couple of trading days, we've seen a mere modest, what are we talking, a mere modest kind of 600-700 point rally in the Dow Jones. Mostly visible really since Thursday and Friday of this week. And we've seen sentiment very much tail back into session highs. So now it becomes a case of, can the markets really try and break out through some of these areas? So we're seeing S&Ps continuously grind higher highs, new pullbacks, back to key validity areas, kind of liquidity areas as well. We're seeing that kind of churn to new highs again. S&Ps, NASDAQ in particular. It'll be now a big case to see, can the Dow Jones also follow that? Can Wall Street Dow Jones, US 30 follow that and continue progressing higher as the Lagarde indice that's currently being played in the US markets? Now, of course, in Europe, we're seeing some fairly decent returns. We had this consolidation, this apex move last week or the middle of June into heavy selling last week. We found a little bit of a bottom. FTSE 100 in the UK is definitely seeing some resilience off the back of that. We're seeing the same thing in the DAX. Previous highs in May, back to this value area around 15.7, 15.8. New highs again at 16,400. New all-time highs in the DAX. Again, back to this value area. And this week we've followed it home with more bullish price action out of this consolidationary region that's been visible into short-term highs under 16,000. And we have that aggressive a break today through 16,000 as price action continues to tick to the outside. So that's really the outsetting barometer here at the minute, is we are seeing this risk on rally across the board. We're seeing stronger indices hold up despite obviously that little bit of a dollar recovery in the early parts of this week, and we're still seeing European indices do traditionally very, very well. And of course the same can be said for Euro stocks, which is almost back to all-time highs again. So when you factor that back into other markets like the dollar, right, so the dollar has been creating really since the early parts of June. We've been kind of grinding and gradually moving lower with a fairly continuous pace, right? So every time we've made a new low, we've got a little bit of a pullback. So that kind of typical atypical trending price action is being very much confirmed until really this week, where we started to go the other way, right? We started to create short-term highs, a little bit of a pullback into value area down here. Then we're seeing successive highs and lows until we saw that aggressive break. So obviously today, in particular, there was definitely some movement at 1:30 off of that data prints. So you've had personal core PCE and PCE figures coming out. We've had personal income spending. So a lot of these figures has actually been coming in less than expected. So normally when it comes to inflation, it comes to interest rates, and it comes to expenditure figures, you want those figures being lower than expectation. If you see those figures being lower than expectation, you're going to see selling in dollar, you're going to see traditionally buying in indices, and that is exactly what's happened. All of those data points have come in lower than expected. So from an arbitrage, short-term, high frequency, or even news trading perspective, we were seeing that correlation play out very, very cleanly in the markets, whereby it's allowing this indice rally in the stock markets short term. Let's say, for example, you can see it very, very clearly from this 1:30 level, even particularly today, 1 o'clock, very, very clear buying. And at the same time, if we melt down into the DXY, you'll see it there from 1 o'clock, very, very clear selling off. So we're starting to see those movements. Was there a little bit of a leak? You could start to see it moving a little bit early. Who knows? Is it maybe more market makers? I would suspect that's probably more the case. And we're seeing those moves become very, very clear today. Now, with obviously that weaker DXY, we're seeing Euro USD collectively move higher. We're seeing GBP USD move higher again. We are seeing this dollar yen play, which has been on that steady grind over the last number of weeks, that steady grind up really back into this area. If you heard recent comments from BOJ speakers, you would see that they're very, very closely watching this kind of the updates regarding this, because we know the BOJ had to become involved in April and May, and even moreover beyond that, even last October, November, when the dollar yen got to 150, 152, there was central bank involvement to kind of bring some sort of resilience strength back into the JPY. So we're heading back into some of those levels again. So it's important to be very, very conscious of that as we approach new quarter, obviously new week, new quarter, new month, and obviously the second half of the year, broadly speaking. And that really rounds us off really in the FX markets with the Aussie, right? Because we know that the Aussie, we talked about it last week, we've talked about it in the daily notes over the last few weeks, that aggressive break to the downside, aggressive break to the upside. We've come straight back to this value area here. So this value area has been fairly visible around this 66, 66.50. And of course today we are finding, yesterday and today, we're finding a bottom at 66, very, very clear, very, very apparent, and we're starting to see the Aussie grind up. And now it becomes a case of, well, we've had a very, very clear bearish moving price action trend structure. Can we start to see a mean reversion in that, whereby we've taken lows, we've taken highs, we've come back into this value area, as we've noted here in this region here between 66, 66.50, and can we continue to trend to the upside? So that becomes the next key deliberation into H2 of 2023. And then last but not least then is the gold play, because we know, right, the dollar has been traditionally quite resilient over the last few weeks, or last week, shall I say, last week, week and a half, going from this 102 level all the way up to 103.50. But we've had a fairly steady decline in the last few hours. We've gone from 103.50 all the way back in under 103, and that's really aided this gold pullback, because we know gold has been a fairly reasonable outlier for downside volatility. We've seen that fairly decent grind. You can even look at the order flow. All of these blue marker circles, continuous order flow to the downside, taking out new lows, manifesting bearish moving price action within the financial markets. And of course, as we see that correlation, as gold hits a new low and the DXY hits a new high, as the DXY starts to move lower in terms of weaker dollar, we're very clearly seeing the gold prices then spike back up. And this area that we've talked about last week, and of course this week, around the 1925 level being worthy of our attention, given that we have now made new lows underneath the 1910 level, and subsequently, even in addition to that, the 1900 level. So really kind of setting the tone next week. I think the primary goal is to ascertain confirmation in terms of how we closed this week. It certainly looks like indices are going to close or try and close higher. We're seeing that resilience in terms of the gold markets working back up into that liquidity area between 1920 and 1925. More precisely, and of course we're seeing that short-term rally this week in the DXY, really from mid last week, but now it becomes a case of, is that a short-term flash in the pan? And I suppose if we're going to articulate a deeper sell-off in the DXY in terms of dollar weakness, then we really need to be looking for that internal break of structure within that short-term rally that has been visible in the DXY in the last, let's say, as I said, week and a half. Because of course, as I said, just to round that off, you'll see that very, very clear reaction or stronger movement in DXY, highs, lows. We're getting that kind of internal structure to the upside, but we need to see this bullish price action really breaking through. And as you can see today, at this moment in time, we've come down to yesterday's lows at noon, 102.80, and you can see that the price action is currently holding above. So it just becomes a case of, can we navigate a clear break of structure and a break of trend in that dynamic for that rollover in DXY, continuated strength in gold, or whether it's a short-term pullback in dollar weakness for really gold to potentially come crashing lower again. And if you go out to gold, you look at that daily structure as well, you can see that there's some fairly clear buying imbalance that took place in March and April that is still yet to be fully mitigated, which does bring that downside target of sub 1840, sub 1850 really into play, with moves potentially going as low as 1820. But at this moment in time, we're not there yet. We're still creating that influx of price action, that lows into lows into new lower highs, into new lows, and that regurgitation, that repetitive price action structure that's currently being created in these markets. So that's pretty much where we round out the week. So as I said, all eyes is going to be on how we close this week. I think that's going to be important because that's going to set the tone for H2 and of course for Q3 as we start July next week. So of course, everyone have a great weekend, and we'll see you all next week for another video.